Welcome back to FX Talk, an eBrief podcast all about the foreign exchange market. My name is Matthew Ryan. I'm joined as usual by our chief economist, Enrique Diaz-Alvarez. And we have a very special episode for you today because we have a very special guest. Kallum Pickering is joining us. Kallum is chief economist at investment bank Peel Hunt here in London, having previously held senior economist positions at the likes of Berenberg, BNP Paribas. He's also a regular commentator in our space. You may well have seen him down the years on the likes of Bloomberg, CNBC. He also has a regular column in the likes of the Telegraph, the Evening Standard, and the Spectator. Kallum, thank you very much for joining. Really appreciate it.
Oh, my great pleasure. Thanks for having me on board, Enrique and Matt. Thank you.
I think we have a very interesting episode lined up today as well. I mean, for those of you that would have potentially followed Kallum's recent work, he's put out some really good pieces and talked a lot about the topic of government debt, particularly the problems that economies are facing due to high and rising debt levels and an unwillingness to curb government spending and the challenges that this is providing. We're going to be talking about that in detail very shortly. Before we do, I wanted to, as we do, recap the latest news that we've seen in markets in the last fortnight, because it's been a busy couple of weeks that's been dominated largely by political developments. The US government has shut down for the first time in 7 years. And thus far, there's no end in sight, with betting markets suggesting that this could even eclipse the 2018 shutdown, which is the longest on record. The US dollar is holding up surprisingly well, which is a bit of a break from 2018, which in our view is largely due to investors' belief that the economic hit from the federal closure could be quite limited. Political news elsewhere, particularly in France, Japan, seems to be diverting gaze. And actually, we could have a situation whereby no news is good news, given that critical US data has been released, or it's been delayed, I should say, due to the shutdown. Political wrangling in France continues to weigh on the euro. PM Le Cornu resigned, only to be reinstated a few days after. And while that has averted the near-term risk of an election, the government continues to struggle to pass this budget in time for the 2026 budget to come into place. Meanwhile, US-China trade talks and the trade war is back in the news after President Trump warned of massive tariff increases on Friday, only to dial back this rhetoric over the weekend. That's allowed for a bit of a mild rebound in US stocks and risk assets, which were hammered late last week. I think we've timed this episode very well, actually, because these recent political developments, particularly what we're seeing in France, in Japan, and notably in the bond markets there, leads us very nicely into our main topic. And we're going to talk about the bond markets, government spending, and this current political predicament that many governments find themselves in, whereby we have a situation whereby government debt levels are high and rising, and at a time when borrowing costs are continuing to climb, those being the government bond yields, which have increased quite sharply so far this year. All the while, demographic changes are providing a little bit of a headache, namely an aging population and low birth rates, which is leading to this increasingly top-heavy demographic tree. Let's start with you, Kallum. Talk us through this predicament that we're seeing then for governments. Your thesis has been that bond market suggests that the world is flirting with a bit of a disaster. What are your thoughts on this topic?
Well, let's just frame the problem, which is that we, across the advanced world, are experiencing an aging population. Now, actually, in many countries, this doesn't necessarily involve a shrinking population, certainly in places like the UK and the US and even France. But the share of workers who are then moving into retirement will rise and rise and rise as far as the eye can see. And of course, we've made lots of lofty promises to our retirees and pension, healthcare costs, welfare, and basically to say, you've worked all your life, we'll make sure you don't suffer any indignities when you go into retirement. I mean, this is all the sorts of things you'd expect from a civilized society. The problem is, this demographic shift has not been properly financed, sort of ex ante. We've not thought about these problems long enough in advance. And so what we're doing is, as these demographic trends play out, we're borrowing to finance these increased liabilities. So across the advanced world, by a factor of 3, even sometimes 4, government debt to GDP levels are set to rise over coming decade, basically as far as the eye can see. Japan, of course, gives us an idea of the direction that most countries are heading. But what we're seeing in bond markets at present is, with the normalization of global inflation pressures, with the kind of rebalancing of demand and supply after the global financial crisis, which took some time, but in the end it happened as everyone expected it to. We've had this normalization in the interest rate structure, and another thing's happened, which is, thanks to this normalization in the interest rate structure, a lot of the pension funds have actually been able to set their long-term asset bases in a way that can finance their private sector liabilities. So put simply, we need to issue lots of debt to finance an aging population just at the time when the private market's basically saying, we've sort of got enough of this stuff. And the problem that we face is, you mentioned crisis. I think there's a step before crisis that matters, which is, of course, policymakers think there's no problem until something goes bang. This is not true, actually. The interest rate structure that we face across the advanced world and the volatility that we see periodically at the long end of the curve, when especially we have a political shock, be it what we see in France, the fiscal mistakes that we've seen in the UK, even in the US in April around the tariff measures increases, and the risks that implied for the US economy and the outlook for inflation. I mean, we periodically go through these bouts of bond market volatility, and it has real economic effects. We call it crowding out. It's where the interest rates that prevail across benchmark assets are too high for parts of the private sector to get going. It's where you get volatility in bond markets that then spreads uncertainty and risk around other markets. And so we are missing out on key bits of economic growth given where interest rates are. And this is the step before the crisis, which might actually last a long time, given that ultimately everything's relative, of course, but bond markets and government debt markets are still relatively safe assets. And so just because we don't have the crisis upon us doesn't mean we're not paying a high economic price for this. And I think this is the trap that we've now fallen into, where probably several times a year until something eventually goes pop, we're going to be faced with these periods of bond market volatility and this question mark of, why are our housing markets so soft? Why is credit expansion so soft? Why are the normal cyclical components of the economy that take off at the beginning of the cycle, why are they being held back? And this is because interest rates are just too high across these benchmark curves.
I think it's very interesting that you raise that point, because people are looking at the bond markets and they're saying, well, as long as we don't have another trust style disaster, then everything's fine, And frankly, yeah, UK rates have gone up, European rates have gone up quite a bit this year, but US rates, on the other hand, the long-term rates are roughly where they started the year. But for instance, I've noticed that the biggest mechanism for transmission of lower rates of the act of the Federal Reserve starting a new easing cycle has traditionally been the mortgage market. And the mortgage rate in the US are linked to the roughly 20-year to 30-year end of the curve, because they're fixed. And we've had the beginning of what could be a pretty prolonged cutting rate cycle from the Fed, and yet mortgage rates have not really moved very much. They were around 7%, now they're around 6.5%. The 20-year and the 30-year bond haven't had that screaming rally towards lower levels that you used to get every time the Fed started a cutting cycle. So I find it interesting. I think that your point that we don't necessarily need to see a bloodbath in the bond market for this problem to develop, this literal crowding out of private investment, but this ever spending needs of current consumption financing on the part of the public sector.
Exactly. So maybe I throw in two comments here, which I think are, I suspect, Enrique, you'll agree, but if you don't, please let me know. But and these are not consensus views, by the way. The first is, central banks don't set interest rates. Private markets set interest rates. Central banks, at best, can generate temporary distortions, which might be desirable because you're in a crisis or you've got lots of inflation. But in the end, the interest rates that prevail are set by voluntary actors in the private economy that just need to price things like inflation and risk on government debt, and then from that, everything else follows. And we know this to be true. For instance, it's often the case that during periods of so-called tight money, interest rates are very, very low. such as after the global financial crisis, right? If we really think about the mechanics of QE, we're trying to inflate our economies. I mean, QE should have been associated, should it have been successful with rising interest rates eventually. Eventually it came, but it took a long time. So the first thing is it's markets that set interest rates, not central banks, under most circumstances. The second thing is there's, in my view, a very lazy notion that because advanced economies typically borrow in the money that they're able to print, there are no risks associated with this. This kind of concept that there's a free lunch when it comes to public debt, this is wrong for a very, very important reason. And it's wrong because of the way we introduce the debt into the system. So let's say the three of us have a great idea for a private business and we go to a bank and we say, we would like to borrow some money. In that instance, that private bank will create new money when it issues us with a loan. Okay? And it introduces a liability onto our balance sheet. But assuming it's a good bank and it's doing its job, it's done all the due diligence to figure out how we're going to spend it. And generally speaking, when loans are of a large size, they are used to generate an asset in the private economy, a productive asset. And so when you generate the liability in the private sector, typically an asset goes along with it. Now, of course, you have to be careful not to overvalue your assets. Otherwise, you end up in a balance sheet crisis. That's basically the global financial crisis. But this is the process that unfolds. For government, this is not what happens, actually. Most of the debt that we've accumulated has come as a ratcheting effect where governments have borrowed huge amounts to finance current consumption during periods of private sector downturn. And so what you don't have is accumulated assets to finance these long-term liabilities. And just do a thought experiment. UK government debt to GDP, excluding all the exceptionals, let's say it's a little bit below 100%. That has mainly been used to finance current spending over a successive crisis. If with that money we would have bought, well, the economy is 2.8 trillion in global ETFs. And we said, we're going to use this to finance our pension liabilities. We simply wouldn't be in the situation that we're in. That is to say, we haven't generated assets on the other side of the balance sheet. We've just financed current spending. And now we're paying the price in this high interest rate structure. And the paradox, unfortunately, is that the same kind of thinking which leads us to believe that government debt is riskless because we can print our own money, it has a different variety, which is to say that the government is a major player in structural dynamics in economies, and they're really not. And so if you speak to policymakers, the reason why, whether it's an incumbent government or potential opposition's challengers, the reason that they don't want to go to the electorate and say the solution here is aggressive cuts in government spending, we need to say we've made these promises and we're just going to take them away, is because they fear that if they cut spending at this point in the cycle, they'll crash economies. And this is exactly what won't happen. We have so much private sector balance sheet strength, be it banks, be it households, be it businesses, that if a government somewhere were to signal a credible commitment to reducing these long-term liabilities, the market would reward it by lowering interest rates, and then all these cyclical parts of the economy would fire up. And so if you want to say that this would be sort of expansionary austerity, call it what you want, but I actually think that this is the case, because if the logic holds that you have crowding out, the moment you reverse the underlying problem, you will have crowding in.
I maybe also I think that is along the ways of what you said is that the reason why we're not hearing calls for that for austerity is that the mindset of the last 30 years has been one of chronic insufficiency of demand, right? We used to have an economy with a lot more workers relative to the number of retirees that we have now. We had the China shock, which was a supply shock that moved the supply curve significantly to the right. So there was like a lot more being produced. And there were industries in China that still, to some extent, have constant overproduction. So the idea was that government deficits were not a free lunch. So you're doing it was mobilizing resources that would otherwise sit idle. And I think that is less and less true every passing year as the pension problem, as the number of pensioners per worker increases without end. So I think that over the last 10 years, moved to the traditional supply constrained economy where the constraint to expansion is the ability to produce things rather than demand for the things that are being produced. And that's, I
Yes,
think, where a lot of the conundrum is here.
exactly. So I think I make 3 points on that. The first is I'm in many respects I'm a fan of Keynes. I just don't think it should have been called the general theory. It should have been called the specific theory to how you solve a liquidity trap. If those
Yes,
conditions don't prevail, it's actually not very helpful.
right.
But I think there are a couple of things that I would throw in here. The first is after the global financial crisis, policymakers were afraid of creating moral hazard by bailing out private institutions. But in the end, actually, the moral hazard fell on the part of government when interest rates crashed. Because the urgency to deal with fiscal issues, you remember in 2009, 2010, especially in this country, we were deathly scared about the rise in government debt to GDP that would come as a result of the crisis. And so we pursued austerity. But with every year as interest rates came down, actually we saw this as a less and less urgent problem. And so the moral hazard was on the government side. And of course now we're paying a price for that. The second thing which I think is key is when we think about crowding out, we can think about it through two respects. One is through the interest rate structure. The second is when you have a supply constrained economy, because the government tends to be less price sensitive than the private sector, in marginal ways, it outbids the private sector for resources. And
Right.
because the public sector is
Very
not
good
as
point.
productive as the private sector, as you increase the share of government spending to GDP, by definition, you're using scarcer and scarcer resources in a less and less productive way. And then you start to chase your tail, which is why we've had this precipitous rise in government spending as a share of GDP. And then there's a third thing, which I think just goes to the mechanics of an aging population and the way we set policy. So I'll give the general example, and then I'll give the specific policy problem in the UK, which applies broadly, which is, and it's especially a problem when you have a growing population that's aging. So as the population grows, demand is growing year after year after year. But then as the share of workers within that population shrinks, the share of people contributing to supply is declining. And so you get this inflationary trend because you get this structural imbalance between demand and supply. It's why as it goes, I have high hopes for AI because it simply can't be true that our two biggest problems are mass worker displacement because of AI and a shortage of workers because of an aging population. You have to pick your poison. But then when we set policy in this environment, so we say, just mechanically speaking, we have a lower share of labor supply as a population, which will be inflationary as demand grows. And then we set policies a little bit like in the UK we have this triple lock, which is where we say, we will grow our pension spending each year by a number, inflation, or wages. And so if you take inflation, you're embedding inflation into the system because what you're doing is you're saying fewer and fewer people are working as a share of the population, and that pushes up their wages because they have pricing power, which generates inflation. And then you say, well, promise to pay the working share indexed according to whichever one is highest, inflation or wages. And so you have the structural inflation, and then you accelerate it with your policy choices. Um, yeah, this is not sensible policy to say the least.
No, I agree with that. Uh, and one question I would have, it's like, okay, I think we share a general worldview, economic worldview, but where do you see markets and macro going over the short to medium term from here to 2027? What do you expect to see in the economy? How does an investor protect themselves against potential downsides from this situation?
So
What would be your view?
um, we have an unusually complex economy insofar as we have multiple factors which are having both cyclical and structural effects on demand and supply. So we're just repeatedly seeing dislocations. And there are a few trends emerging. So I think as a useful exercise, we say, let's not focus on the specific issues, be it geopolitics, be it US isolationism, be it regressive industrial policies in Europe. But I would to say, this is the thought experiment to make. The world will muddle through with okay growth. We'll have a bit more inflation than we would like, but not so much that central banks can't cut interest rates. And we're not ready for a recession yet because we don't have cyclical imbalances in the private sector. What would you expect to see? Well, equities are a nice inflation hedge. So you'd expect to see if equities move. You'd see a bit of a discount rate effect from central banks and a liquidity effect that pushes up risk. But then you would say, well, when you start to factor in some of the issues, be it high government debt, be it geopolitics, you would expect to see some hedging going on, which is why I think we'll see interesting things happen with the oil price and the gold price in context of this sell-off at the long end of the bond market. There are a couple of other market trends which I think are important. The first is the idea that there's a big de-dollarization trade going on today. I think this is right in spirit, but I think it's greatly exaggerated. And so what I would say is we need to distinguish between the normal forces in markets that lead to long-term trends in the dollar, both positive and negative, and the phenomena of de-dollarization. And so the reasons why you might say we might be moving away from a strongly dollar-based world would be not related to US government debt, actually, but to do with the fact that America is harming some of its institutions and it's closing up its economy. And typically, this has not been a long-term strategy to retain hegemonic influence in the world. Quite often, if you don't have a template upon which other countries can base their institutions, and if you don't pay the price of the current account deficit in the US's case for financing the world, you don't retain your influence so much. And so I think that there's a bit of a story here, but I think it's greatly exaggerated. I think it's a risk rather than an event. Then there's this particular question of de-dollarization, and you asked me what's happening in the world up to 2027. So my view would basically be as follows. We see in the Western world a narrowing of the transatlantic growth gap. And if you take this story in 2023, you had a big fiscal stimulus in America, which added at least 1 percentage point through direct and indirect effects to real GDP momentum. That carried over into 2024, and that was basically the three big policies from Biden, the CHIPS Act, the Infrastructure Act, and the Employment Act. Then in Europe in 2023, you had a real effect from the supply shortage coming from gas markets, plus the weakness in demand as we raised interest rates around the world, which dampened global production and global trade. And so the growth gap Europe-US was 3 percentage points at that point. And you had, of course, what I think is a genuinely exciting trend in tech and AI. And so you had two effects happen. You had this concentrated effect in American markets, and then within American markets, this concentrated AI trade. And because you didn't have any growth in other parts of the advanced world, you saw very little market activity, and that coincided with a very strong dollar. Then last year, you got a bit of a closing of the transatlantic gap, but not much. Europe got about 1% growth. America was still close to 3%. And a lot of the market patterns which worked in 2023 worked again last year. This year has been a decidedly different year, insofar as two things have happened in America. The first is the cyclical benefits of the big fiscal stimulus started to wear off. So the underlying economy has slowed. Then you had this sudden modest jarring effect coming from trade policy. And this happened when the valuation gap between US and Europe was historically large. And Europe just built up a little bit more momentum this year. And why do I tell this story? Because when you look at the dollar trend, the dollar is weakening. It's weakened on a trade-weighted basis, let's call it 12-13% since the start of the year, but decidedly against the euro and sterling. The trend that is unfolding is that if we think about currencies as proxies for flows of funds, because they're prices, they correspond to demand and supply like any other price. When the dollar is weakening against the euro and the dollar is weakening against sterling, as this transatlantic gap narrows and as the valuation gap narrows, this is just telling me nothing more than when new money is allocated at the global level, the share which goes to America is declining because economic differentials have narrowed. And we've seen this in the past before. We had a big appreciation in the dollar and a big run up in US markets from 1979 to the early 80s. When the US was doing well under Reaganism, Europe was in a bit of trouble, especially the UK. From the mid 80s to the early 90s, Europe was doing well. There was excitement about the end of the Cold War. We had the big bang in the UK. The dollar weakened about 50%, actually. From the early 90s to 2000, it appreciated again on the first tech boom. Europe had a bit of trouble. We had the ERM. German reunification was bad. 2001, the bubble burst. 2000, the dollar weakened through 2008, and it's just appreciated again up to 2024. And so every, say, 5 to 10 years, you get a 50% appreciation in the dollar, 50% depreciation, and you go on these trends, and it just reflects these price differentials around the world narrowing and growing. And it
So you think that the recent downdraft in the dollar is mostly a readjustment of a currency that just got too expensive in relative terms to the world?
The currency wasn't too expensive, but the price differential in the underlying assets in dollars versus euro and dollar versus UK became too large relative to economic performance.
I can see, for instance, the massive outperformance of US equities if you don't adjust for currency relative to European currencies, where you have in mind. That's what's being corrected.
So if you go from 2010 to 2024, the net international investment position into America grew from about $2.5 trillion to about $24 trillion. So money just moved into America and it pushed up the dollar. And now the US is still amazing. It's still the best, most liquid market in the world. But I probably want US plus some other stuff. That other stuff is having marginal effects, which are now being reflected in dollar trends. This has nothing to do with de-dollarization. We had weakening in the dollar through the early 2000s and in the late 80s that was not associated with de-dollarization. I think this is the biggest story, and we mustn't confuse the two.
Yeah. I think that's a common misconception, actually. We've talked about de-dollarization quite a lot in the last few months because it's obviously been a hot topic in the news, particularly since Liberation Day in April. But actually, there is this misconception that de-dollarization automatically means a weaker dollar. Actually, those two things are not necessarily correlated. I mean, you can have this process of de-dollarization, but the dollar can still strengthen.
Exactly.
So I think that's an important thing that we certainly emphasised in the last few months.
I think that's exactly right. Look, if you don't supply as many dollars to the world because it's de-dollarizing, the currency reflects demand and supply for dollars. Like you can easily prop up your currency in a world of de-dollarization by issuing fewer treasuries.
Yeah. I wanted to get your view on the efforts to reduce debt levels. There's a big topic we're talking about today. I mean, it's I think it's probably a good distinction to make between countries that sort of made efforts to reduce debt levels and then those that have actually been successful. If you look at the last decade or so, most, if not all of the major nations, or certainly not all, but most of the major nations have attempted to lower the debt to GDP ratio. You look at the EU with its Stability and Growth Pact. Germany has its famous debt brake. In the UK here, we have fiscal framework targets in order to reduce the debt. But very few have succeeded. I think it's only really Germany and the Netherlands are the only two standouts that we've seen in the last 10 years or so that have actually managed to reduce debt levels. Almost everywhere else, you look at the US, UK, Canada, France, Italy, the list goes on. Governments have tried and failed to lower the debt. Obviously, it's not been easy recently with the impact of the pandemic and economies need to grow, which has not always been possible in the last few years. But what can governments do, and what would you sort of recommend in order to avert this debt crisis that we're seeing?
Even in the case of Germany, they managed to reduce it a little through the 2000s, but really not a great deal. And for the most part, it will be probably reversed within 2 to 3 years, given the current fiscal trajectory. Like even Germany now is on the debt-financed expansionary fiscal path. I think I'd probably make a few points here, which is to say that we have had it. Most advanced economies, or in fact, all advanced economies are what we will call mixed economies, where there's a state sector and then there's a private sector. And over the past 10 to 15 years, we have expanded the state at the price of the private sector. And it's mainly come because we have preferred to try to preserve public services at the expense of economic growth. And actually, we have failed on both counts. We are now unhappy with our economic growth and we are unhappy with our public services, which is why we have so much populism around the world. And so what you tend to find is the countries that reduce their debt to GDPs are also the countries that reduce their government spending as a share of GDP. And there's no coincidence here. This again is just this crowding out effect. And so there are three things, in fact, that I would like to see. And I'm speaking mostly about Europe, but the US, this applies too, but it's just on many counts less badly behaved than Europe. So we have done three things in Europe which have been bad for our long-term trajectory. We have had this ratcheting effect where we've grown state spending for every crisis, and we have grown our tax base in a haphazard way. And so it has not been done in the most growth-friendly way. The second thing that we have done is we have over-regulated major parts of our industry. And so now major parts of economic activity are simply prohibited by the laws that we now have on the books. And in Europe's case, the Draghi report a year ago spelled this out very, very clearly. And that means that we are excluding economic pie from being eaten by the state, to keep the analogy going. Like, the economic activity simply doesn't take place because a lawmaker said this is not allowed. The moment you take this rule off the book, the activity takes place, and then you generate more tax revenue and you finance this spending. And this is, of course, all been done in the name of the various good causes, but in the end, the result has been weak economic performance. Then the third thing, which is absolutely critical in context of this AI trend, is that we have basically decommissioned what we consider to be dirty forms of energy and unsafe forms of energy. So in the UK's case, hydrocarbons, but in Germany, things like nuclear too. And because of this prohibitive regulatory framework, we have not built out clean energy capacity to offset it. And so you take the case of the UK, which is the case that I know most well. The available energy to the economy, expressed as the amount of electricity available to the economy, has declined by 25% since 2005, when we embarked on these policies. And artificial intelligence and all capital requires energy. So when we think about productivity is this kind of abstract notion, but it's actually something very, very real, which is the ratio of machinery to workers. Modern machinery needs to be plugged in. And so it can be expressed as energy over workers. And so the combination of putting public services ahead of economic growth, of over-regulating, and then throttling our energy markets has meant that we have dampened potential economic activity. And Enrique, to your point about we now have a scarcity problem, a supply scarcity problem, much of this has been self-inflicted. And so our economic pie is smaller than we need it to be to finance our public sector promises. And so the solution to this is actually to not really focus on the 2 to 3 year spending horizon, because actually this doesn't matter all that much. It's to have the confidence to take away some of these long-term promises, or at least refinance them in a different way. It's to open up our energy markets, which will raise supply and drive down price. And it's just to take a knife to large swathes of regulation, especially in construction and infrastructure, and just let the private sector try to solve some of these problems. And I'll make one final point on this. Just as, you know, it's modern life, we're all told a bad diet causes inflammation. Okay, great, we know this. Bad policy, a diet of bad policy causes inflation. The inflation is the price signal that we need to increase supply. And the inflation is the signal for the private sector to make profit. And so curiously enough, the solution is already there. If we were to just open up the private sector and let them try and make profit at these high prices, we would see our supply problems resolve themselves over time. We don't need the wisdom of the policymaker to try and solve these problems for us. The adaptive mechanism of the private sector, if only it were allowed to, would actually resolve lots of these real economic troubles that we have.
Yeah. No, I wholeheartedly agree. I mean, there is this obviously age-old tug of war between the left and the right on the political spectrum. You don't. The risk is, you don't want to cut spending so much that public services are sort of decimated, but at the same time, what we're seeing in the UK at the moment, if we're continuing to fund the public sector through taxing the private sector almost to death, you are triggering that classic crowding out effect that you talk about, and that ultimately, with the private sector fueling most of the growth, that's going to lead to weaker growth. It leads to weaker tax receipts, and then all of a sudden you're back at square one where you were, and those tax hikes risk sort of becoming perpetual. Kind of leads us into maybe discussion on the autumn budget, because as we know, the autumn budget this year, scheduled for, I believe, the 26th of November, shaping up to be one of the most important risk events in the UK in the next few months. I mean, for my money, I think the autumn budget that we saw in 2024 was quite a big gamble from the Labour government. We saw massive spending increases, around about 70 billion pounds, tax hikes, and borrowing in order to finance that, the tax hikes, potentially risking weaker growth. We've already seen softness in the jobs market, and the increased borrowing that obviously places an increased risk premium in UK debt. Borrowing costs have continued to rise, and even the spread between the UK's gilt yields and that of its G7 peers, that has continued to widen. So while you could argue that higher yields are partly due to global factors, clearly this increased borrowing, it seems to be having an impact on pushing up yields as well. So Labour sort of betting that this spending is going to pay off and offset those factors. But it looks as though there is still that shortfall. Growth's been okay, but it's not been brilliant. We've not been growing gangbusters in the last few months. Productivity forecasts have actually been cut. Bond yields, as I said, have continued to climb, and that's led to limited room for further borrowing. So it looks as though the government, left with three choices: either cut spending, which is obviously what we've talked about, but it looks as though Labour have been unable to do that. Particularly given some of the the more left-leaning members on the Labour Party opposing those spending cuts. They could increase borrowing again, but that's going to be very difficult due to high borrowing costs. The third option, of course, is more dreaded tax hikes, which looks almost certain. Kallum, what are your thoughts ahead of the budget? Where do you think Labour will go after? Where do you think the sort of the burden will lie?
So I think the way to think about this is almost like a traffic light. There's a green outcome, there's an amber outcome, and then there's a red outcome. So the green outcome would be the government probably, let's assume they have to fill a hole of, say, 25 to 30 billion. The green outcome would be they return to the issue of welfare spending, which they had promised actually as part of their manifesto to at least try and bring under control to a degree. They tried and failed to make cuts in a major way in June. That was partly because the Conservatives didn't back them. The Conservatives actually, by the way, have said they will back Labour on welfare reform. So it's possible that they just assume, say, 10 billion of additional welfare cuts, and then they'll try to write that legislation. That's a good outcome for markets because it signals a credible approach to resetting incentives in the labour market. I think they'll probably try to spend a little bit of money on tax compliance, and the OBR might give them sort of 4 or 5 billion. And then I suspect they'll freeze the income tax thresholds beyond 2028, which might give them another sort of 8 or 9 billion. And I think that's the green outcome. I think that's the outcome where markets say that's a fiscally credible solution. You are setting the incentives in the labor market in the right way, and fundamentally you're signaling that you can bring spending under control. I think if that happens, I think markets like it. They'll be pleasantly surprised given how weak expectations are. But then, of course, you have to pass the welfare reforms, and you have to stare down the left of the party, the anti-cuts left of the party. The neutral outcome, and again, this is where I think the consensus risks being lazy in their view, which is Labour just forget about their manifesto promises to not raise income taxes, and you put 2p on the main rate, which gets you a big number, 15 billion, maybe more. You freeze the tax thresholds, income tax thresholds beyond 2028. Maybe you do a bit of non-compliance stuff, and you make the numbers that way. And the argument there is, again, a bit of a textbook one, which is the economy has been growing okay, not great, sort of 1.5% to 2% for the past 2 years. We need better. But we've had actually pretty good income growth in the UK. Household saving has been rising. And so if households aren't spending their income, you should tax it as a government. This is a very Keynesian view of the world. I think that this is a risky strategy, because part of the reason the economy is weak is because households are so skittish, they're so cautious about the future. And so if you heap more tax increases on their income, you fear knocking confidence and inducing even more precaution. That is only an amber outcome because an income tax increase would be decidedly disinflationary because it would weaken consumer demand. The Bank of England then are open to do, instead of maybe 2 cuts next year, 4, 5, or even 6. And you do a kind of Reuben Clinton US a la early 90s, where you raise taxes, the central bank cuts interest rates, and you offset the tax increases with the monetary stimulus. And so I think you get to an okay outcome in the end, but you have to go through a journey. But I think the bond market would actually very quickly work out, if you raise income taxes, that this would be the Bank of England response. And then the red outcome is the bad outcome for markets. They reintroduce just another horrible patchwork of anti-growth tax measures, which are inflationary, they're distortive. Even if they get the government to a number that it needs for its budget, in the end, they're anti-growth, they worry bond markets, and you don't solve the underlying problem in 6, 12 months, whenever you have your next budget. You're basically back in the same situation again. I think the government, so that's basically cabinet, that's Keir Starmer, the Prime Minister, and Chancellor Rachel Reeves, would prefer either the green option, go after welfare, or the amber option if they can sell it. I think the politics within the Labour Party tend more towards that patchwork, which involves things like inheritance taxes and pensions and housing taxes and capital gains. And so we're going to have to see which way things break. My hunch is it's going to be a bit of a mix. We'll end up in kind of the amber zone. And then we'll see if it's disinflationary enough for the Bank of England to react. Let me make a broader more point about the UK, which is the UK is not uniquely badly positioned in this fiscal story, right? You mentioned 2027. So even if you take the consensus economist estimates for the UK, we'll be the second or third quickest growing economy in the G7. We'll have probably the second lowest, debt to GDP. And the government, based on its current policy, will actually have a falling deficit, whereas in other countries it's rising, probably ex-Canada. So we're not uniquely positioned as the worst country with our growth and debt dynamics, and yet the market is much more skittish about the UK than other countries. So there's 2 reasons for this. The first is just market dynamics. We are, of the 4 reserve currencies, so dollar, euro, yen, sterling, the least liquid and therefore and smallest market. Right? The dollar is the global reserve. Euro is basically a hard currency. It acts like a gold standard in all respects. And with the yen, you have this big domestic buyer, and it's the big liquid Asian market. And so the UK, having a less liquid market, simply faces much more volatility in the long end of its curve, right? All else equal. The second thing is we have had badly behaved policymakers for the last 10 years in the UK, which have repeatedly decided to increase the risks associated with global investors lending their hard-earned money to the UK. And so bond markets talk of this moron premium. And this, of course, is the additional premium which we pay because we have lost credibility in markets. The reason I set this up is because the UK tends to fall into two camps when it comes to the market. The market either really likes the UK or it really dislikes the UK. It's rarely sort of in the lukewarm category. And this is not a modern phenomenon. Actually, in the early 90s, market really didn't like the UK, right? 2009, really unhappy with the UK. Early 80s, late 70s, really didn't like the UK. But then in between those periods, really, really liked the UK. Okay, so what's going on here? Policymakers that recognize that the UK is uniquely vulnerable to being penalized for its bad behavior either acknowledge this and use it as a disciplining device, or they don't. So during the 80s, remember Margaret Thatcher and her government introduced index-linked gilts, which is to say, after the inflationary 1970s, we will promise to pay our lenders equivalent to inflation plus the rate, and therefore we'll protect your money as a signaling device that we are committed to low inflation. And that helped bring markets on side and it disciplined government decisions. Then, of course, Gordon Brown in 1997 introduced a new device, making the Bank of England independent. And again, that was a credible signal to low stable inflation with markets. In 2010, George Osborne, the Conservatives, made the OBR, the Office for Budget Responsibility, an independent institution with which it would allow its fiscal rules to be measured. And that generated some credibility with markets. What we have struggled to do over the past, say, 5-10 years is introduce a new signaling device to markets, which disciplines policymakers against bad behavior. And that's the thing that the UK needs to introduce. And I think in that respect, it needs to start being a little bit inventive. And it may be that there are all sorts of ideas out, but there's probably a sensible argument to strip out some parts of fiscal policy and make it independent. This idea that you split the treasury in two. But the UK typically has innovated ahead of other countries because it needed to signal discipline. When it's done this, suddenly it's been well liked by markets. And my hunch is actually because of this additional vulnerability that the UK has in the structure of its markets, I don't think we're in a bond crisis yet, but the UK is probably the most vulnerable of the G7 countries to a sudden crisis, which forces bad behavior to be resolved through institutional change. I think when we see that, suddenly the UK starts to look very cheap and very exciting. Until then, I think it's difficult.
Yeah, I think that's a really interesting point. And I think you're absolutely spot on. We have seen, particularly the last sort of decade or so, certainly since Brexit, there have been these big events in UK markets that have really jolted confidence. In Britain, the Brexit referendum, we always had the Liz Truss mini budget mishap, and ever since then, really, this risk premium has not really gone away on UK bonds. And in fact, since Labour, as I said, since Labour were elected, we continue to see this widening in the spread between the UK and its major peers. Let's see what happens in when is it, the 26th of November. Hopefully it'll be a non-event. I mean, usually these budgets are, but obviously in recent years, not so much. We'll be hoping it is nice and calm and orderly. But yeah, as you said, I think it's lots of difficult choices. I certainly think that they'll be freezing the income tax thresholds. It sounds as though they could be going after the housing market, inheritance tax. At the moment, it seems as though they're sort of scrambling around, seeing where they can tax. So we'll find out. It's going to be interesting period for the UK. If you consider obviously the budget, and then we've got what the Bank of England might be doing next year. It'll be interesting to see whether they cut rates again before the end of the year. We suspect not, but what will their response be in 2026, particularly if this budget it potentially is an anti-growth one. As you said, there we could see a more aggressive Bank of England next year. So that's going to be fascinating in the next few weeks and few months.
I think so. I think, the closing comment from me, not just about the UK, but about the global economy, is that yes, the future is uncertain, but the underlying mechanics at play, like how are the economic fundamentals playing out, and what are the processes underlying them, these are not uncertain. Again, Enrique, please tell me if you disagree, but we have so many textbook stories playing out. Like, the tools of an economist really apply. There are no mysteries about what is going on in the underlying economy. I mean, the real challenge in the uncertainty is associated with whether largely governments have the confidence and the courage to face up to some of these fundamentals and then address them with the right policies. But this is not, for instance, like the period, say, 2012 to 2015, when we all expected a reflation and it didn't happen. And there was a bit of head scratching, like, no, right now, like, we can see the positive and negative supply shocks. We can see the deglobalization. We can see the crowding out. We can see this absence of momentum in cyclical sectors, and say, well, yeah, there's a textbook there which actually explains this. We might not like the answer, which may be why we're reluctant to face up to some of these stories. But I think we have a very textbook economy, and I, I again, I think it's the doubt is on the politics, not in the economics, in my view.
Fantastic. That's excellent. I think there was a really good discussion. We really enjoyed your input, Kallum. That was fantastic. Yeah, is there anywhere that our listeners can find you? Obviously, we said you have a column in the likes of the Telegraph, Spectator. Is there anywhere else where people can find and read your content?
So I'm on LinkedIn. I do share content, so please follow me and just add me as a friend. We'll accept. I also have an X, which is Kallum Pickering, and you'll find me Kallum Pickering Economist. And actually, I do have my own podcast called Macro Minds, where I have not just economists, but kind of other experts, historians, and the like, to kind of help us kind of decompose and deconstruct and decode the world and try and understand it a little bit better. So, yeah, that's where to find me. Thank you so much for having me on. It's been a real pleasure.
Brilliant. No, really appreciate it. It's been a really good conversation. We really enjoyed it. Fantastic.